Business, Channel 602, so just under an hour's time. Moving on now, the value of loans outstanding to the private sector continued to grow at a steady pace in March. According to the RBA's financial aggregates for the month, total credit increased by 0.4% after increasing at the same pace in February. Personal credit fell 0.1%, business credit was up 0.2%, and housing credit grew by 0.5%. For more, we're joined by Felsman from Colonial First Aid Global Asset Management in our Sydney CBD studio. Ryan, as always, great to have you on board.
Thank you.
You make the numbers.
Well, I think, as you mentioned, it was a fairly stable increase. Certainly, though, if you look at the actual annualised numbers, overall credit growth up at 4.4%. And that's a five-year high. So certainly we're seeing a return to stronger credit growth. But having said that, though, if you look at the average since 2000, credit growth is around 9.3%. So it still remains below that level, but certainly driven by housing credit in particular. Housing credit's up by 5.9% annualised, driven predominantly by investors. Investor credit growth up by 7.9% annualised, but that's still slightly below its peak in 2010 of 8.4%. So we're still seeing this whole dynamic play out, of course, where certainly investors entering the property market, searching for yield, and at the same time we've seen the RBA previously quite concerned about this. So in their financial stability report recently, they talked about self-managed super fund investors. At the same time, offshore investors remain a key player in terms of demand, although in absolute terms are actually quite low still. So one of the concerning aspects of the credit growth numbers, James, of course, was around business credit growth. It fell to its lowest level in 4 months on an annualised basis at 2.6%. And certainly businesses remain cautious. We've got uncertainty around the federal budget. Businesses remain reluctant to spend and invest. And certainly the reluctance is around the fact that demand, or domestic demand, still remains quite weak.
Do you expect to see the level of credit growth get back to those levels you mentioned that were pre-GFC, or is it a new paradigm? Is the landscape shifted, to the point where it doesn't go back to those sorts of levels post-GFC?
We think that credit growth overall probably increased about 6% annualised this year. So certainly in the short term or near term, we don't expect it to eventually get back to those levels. Housing finance data over the course of the last couple of months has actually been a little bit more subdued. So at this stage, we think 6% probably for this year at this stage.
Ryan, John Noonan from Thomson Reuters. Good afternoon.
Good afternoon, John. How are you?
Very well, thanks. Now, next week we get the Reserve Bank meeting, and obviously that CPI number would have relieved them greatly. That it appears that the Q4 CPI was a one-off, the hotter than expected Q4 one. It gives them a little bit of leeway now, or at least that they can focus on growth. Do you think maybe they'll use the fact that inflation isn't so much a worry to give the Aussie another kick by saying it's uncomfortably high, or maybe just their language a little bit?
Perhaps, though, if you look at their strategy, the last few months have retraced from that strategy in particular. I think the removal of the mild easing bias has contributed to the Aussie dollar sort of trading in this 91 to 94 band. And certainly core inflation, while 2.7% annualised for the March quarter, still remains sort of towards the top end of the band. And one of the concerning things, of course, around the Aussie dollar impact is tradable inflation. Now, tradable inflation is actually running at an annualised pace of around 2.6%. So I think they're quite wary of that fact. So certainly, while it gives them some breathing room, I think they're still mindful of the fact that there are some inflationary pressures building in the economy.
So where does it leave the outlook for rates? Because certainly there are people scrambling after the CPI that, as John mentioned, weaker than expected, to change any views of potential rate increases this year.
Yeah, I think if you look at sort of the outlook for monetary policy, I think certainly in the near term we're going to have a period of stability in terms of interest rates. They've made that pretty clear. But certainly I think the unknown around all this is the federal budget. Now, I'm not sure what Treasurer Hockey's strategy around this is, in particular if there is a strong fiscal consolidation. Now, we may have the strongest fiscal consolidation since 1996 when Howard and Costello came to power. We may not. This is the great unknown, of course. And if that does play out and fiscal policy tightens, I think that Hockey would look to see monetary policy remain where it is, or interest rates remain low for longer. and this would obviously have some impact on the Aussie dollar. And now you saw his strategy in particular a few weeks ago where he tried to actually jawbone the central bank. So it's pretty clear what their strategy is. So I think that's probably the great unknown as far as monetary policy is concerned this year.
What would you like to see happening from a fiscal side, in terms of the budget? Would you like to see some tough measures taken despite what impact it might have on a tightening of economic growth and subsequently pressure on the RBA, or do you think it needs to happen structural reform?
I think there needs to be a balance, if anything. Certainly the government's got a delicate balancing act. They need to embark on a process of fiscal reform, in particular fiscal repair. Certainly the budget position as it stands isn't strong enough to withstand perhaps another GFC type event, so they need to implement some changes, no question. Perhaps a more efficient way would be a broad-based tax reform, implementation of the Henry reforms that were mentioned, focusing more efficient taxes, perhaps GST, land taxes rather than stamp duties, that type of thing, rather than focusing on temporary one-off levies like that's been discussed.
What do you make of that, Ryan? What do you make of the deficit levy? Let's not call it a tax, apparently a tax, it's a levy.
That's right, yeah, apparently it's a levy. So effectively it's meant to be a temporary levy imposed on income earners, particularly those on 80 to 180,000, so there'll be a 1% increase. And those on over 180,000 would have a 2% increase. On top of that, of course, is the 0.5% Medicare levy increase that's taking effect on the 1st of July to effectively fund the disability insurance scheme. So that hit would be quite substantial as far as household incomes are concerned. And economists are obviously quite concerned about the impact in terms of GDP growth, particularly around consumer spending. Estimates perhaps of the impact would be 0.5 percentage points.
Is that right?
Perhaps, yeah. So although they would raise around $6 billion this fiscal year, certainly a reduction in government, consumer spending, so at the same time government spending would have a contractionary effect on the overall economy. So that's the concern. But obviously they're trying to counterbalance that with trying to preserve Australia's AAA credit rating at the same time.
John, I mean, not just economists, I imagine, you're watching it closely, the RBA, albeit made up of a lot of economists.
Yeah, well, that's right. It's amazing, that one, even if it's a one-off hit, that will, Ryan's right, that will definitely impact the economy. We saw, the famous Amanda Vanstone, the hamburger and milkshake handout, actually saw a pickup. For a period of time that the consumer spending picked up, even from the very small addition. So if you take away that much money on a one-off tax, it's certainly going to impact consumer spending and hence the economy, as Ryan said. So I think the RBA is going to be watching very carefully and will try and assess everything that's coming through. I think they'll also be, as I mentioned earlier, they'll be relieved the fact that they don't have to look at inflation right over their shoulder right now as being their top concern. So I think they're in a better position now to weigh up all the impacts that Ryan was talking about, the potential impacts of the budget, and how that plays out in making their policy.
Ryan, do you foresee it being a short reprieve in terms of inflationary pressures, or would you expect the rate to remain somewhat benign for the foreseeable future?
I think in terms of the tradable impact, I think that's probably one of the concerns, particularly if the Australian dollar does depreciate. But certainly at the moment the Aussie dollar seems well supported. In particular, this week we don't really have any domestic data of note. We've got house prices tomorrow. Given seasonal effects, it's likely to be slightly weaker. When I say weaker, appreciation of about 1% for April. So that would take the annualised level up to about 12%, which is pretty strong still, of course. But certainly will alleviate some of the pressures for the RBA to some degree. There's not a massive acceleration going on. But certainly Sydney remains buoyant with house price growth of around 17%, Melbourne around 12%, and even Brisbane's picking up around almost 6%. But there is some evidence that there is a deceleration in house prices in Perth, for example, which are around 5%. So combined with wages growth as well remaining fairly subdued, currently around 2.5%. Certainly the pressures aren't quite as great, but if you look at the domestic component of inflation, it still remains fairly sticky at around 3.1%. and there are some structural issues at play there. So the pressure has been alleviated somewhat, but I think the RBA is still mindful of the fact it's towards the upper end of their band, nearer 3% than 2%, that's for sure.
Yeah, indeed. Look, got to have to leave it there, Ryan. Great to talk as always. Thanks,
Very
Ryan.
much, James.